Hey traders, Jason here from Levitt Brothers. So in this video, I'm going to talk about how the market has changed recently and what you need to do about it. Okay, if I were to make a list of reasons why traders fail, this would probably be somewhere. This would definitely be at the top of the list. I don't know if it'd be number one, but it would certainly be in the top couple. Okay, market changes. The market will operate a certain way. It'll move a certain way. It'll exhibit a certain personality and characteristic. And you can trade a certain way, but then when the market changes, you have to change too. And if you don't change, then you lose. Okay, a change could be, maybe you're shooting for 2-week trades and nailing 20-30% moves, but then the market changes and you could only nail 5, 6, 7% moves that last a couple days. Okay, maybe the types of stocks you trade change. Maybe you're trading tech, and then you have to go trade utilities, something like that. Okay, the market constantly changes, and it's not like it has unlimited personalities, but like during the course of a year, it'll act one way for a couple months, then it'll change. It'll act a different way for a month or two, then it'll change. And if you put your head down and just operate the same way at all times, you will get crushed. Okay, it's September. You cannot trade in September the same way you traded in June. Okay, you just can't. And if you try, you're going to lose. All right, so let's go through how the market has changed over the last couple months. Okay, so here's the S&P 500 just to kind of set the stage here. Solid rally to start the year. Pull back in April, a little bit of a double bottom. Rallies in May, comes back. Notice we got rejected by the 50-day moving average there. Supported by the 50-day moving average there, rallies up to a new high. This is an all-time high. Pulls back kind of hard. You got some big volume over here. Then the carry trade news came out, and the index plunged. You can see it rallied all the way back, and pretty much it didn't get a new high, but it pretty much got to its high. Okay, so overall, it looks like we have a large range forming. I'm going to call it like that. I know we had a little dip below there, but for the most part, over the last 3+ months, we have traded in a range, as you can see here. Now let's look at the NASDAQ just as a point of comparison. Same rally to start the year, same pullback, same little double bottom with the 50 as resistance, moves up, comes down, tests, and moves up to an all-time high. It too pulled back, although the S&P, with the S&P, the 50 was like here. This one pulled back. The NASDAQ pulled back further. Same carry trade weakness, rallies back. But note here, the S&P got close to its high, and the NASDAQ is far from its high. Not super far, but far enough to be notable in the short term. Okay, so there's definitely a change here where the S&P rallied all the way back. The NASDAQ didn't even get close, and that's very notable. All right, so let's look at, now let's take a dive beneath the surface and see exactly where money is flowing and what kind of change is taking place. All right, here's the SP high beta index. Kind of sloppy. So high beta is an official designation. Beta deals with how closely a stock trades relative to the index. So if a beta of 1.0 means you trade exactly with the index. If you're above 1, you trade more than the index, meaning if the S&P went up 1%, a high beta name would go up 1.1, 1.2, 1.5, 1.7, and a low beta name would go up less, would be less, be coming less than 1. So if the market went up 1%, a low beta name would go up 0.5%, 0.6, 0.7%. Okay, so this is a low beta in S&P index. You can see new high here, fell hard, tried to rally back, and you can see this is like really extreme here, below several previous lows, rallies back. You can see it doesn't even come close to the high here, and then it fell hard. Okay, so this is the high beta index. Let's look inside. This is the composition of it. The holdings, you got SMCI, Monolithic Power, NVIDIA, AMD, Teradyne, Broadcom, CLAC. Okay, a lot of tech holdings. Tech is 47%, consumer cyclical 17%, so you can see there. Okay, so this is where high beta names fell pretty hard, could not match their previous high. Okay, so we got a lot of tech names, almost 50%, that did not do as well as the S&P. Now let's look at low volatility. Okay, you can see a gentle move up from left to right. I mean, this is literally bottom left to top right. S&P over here went up and almost hit its high, and this went well into new high territory. So there's definitely been a shift between high beta and low volatility. Let's look at the holdings here, and then we'll look at both of them at the same time. So of the low volatility, you got Berkshire, you got Coke, T-Mobile, Lowe's, Visa, Colgate-Palmolive, Procter & Gamble, and you got financial services, consumer defensives, those dominate, okay? Utilities, healthcare, tech is all the way down here. Okay, so if I put them together, this is high beta up top, low volatility down below. Both of them hit a new high in mid-July. Then high beta pulled back, not hard, but certainly noticeable, but low volatility did not. Low volatility pushed higher and printed another new high. Then you got the carry trade news came out, and this plunged, whereas this was barely affected. And then you could see high beta could not get back to its high, and then it rolled over hard, whereas low volatility pushed higher. Okay, so starting right here at the July high, there's been a definite change from high beta to low volatility. There's definitely been a preference here for low volatility, whereas the high beta has been not avoided, but definitely traders less interesting in buying those stocks. Let's look at a similar comparison, but we're going to look at growth versus value. Okay, so high beta, low volatility has to do with like how a stock moves relative to the index. So it's kind of like a relative strength type of measurement. Growth value is going to actually be with earnings and stuff. So here is the growth index, where it pretty much matches the S&P all the way up until here. Topped a little bit before the S&P, fell hard, rallied back. But you can see, well, the S&P nearly matched its high. This one, there's a gap there, and then it fell kind of hard. Here are the holdings. This is basically a mega cap ETF. Apple, Microsoft, Nvidia, Meta, Amazon, Google. Okay, it's more than 50% tech. Communication services is basically tech, because that's a huge chunk of that is Google. So you can see that this is a tech, a large cap tech. Even though it's growth, it's a large cap tech ETF. Now let's look at value. Remember the growth one, there was a gap between the high and the current price. So here we got the same new high in July, okay? But then we got another new high at the end of July, and now we have another new high here. So it's kind of the same difference between the high beta and low volatility exists between growth and value. So the holdings here are Berkshire, JP Morgan, Exxon, Johnson & Johnson, United Health Group, Walmart, Bank of America. You see financial services, healthcare. So there's definitely been a shift. So if I put these on the same chart, you get the same divergence that takes place. Both doing really well mid-July. Okay, the growth falls while value moves up, dips, and then moves up to a new high. And then when growth could not rally back to its high, value easily rallied to a new high. Okay, and this plays out with the S&P and the NASDAQ. So here's the S&P and the NASDAQ. Both of them topped July. Both of them fell, and then both of them rallied back. But you can see the S&P, it almost got back to its high, whereas the NASDAQ did not. Okay, so what has happened over the last 6 weeks since the mid-July is you've had a shift from high beta and growth, which includes tech, communication services, consumer cyclicals, to volatility and value stocks, which include financial services, utilities, healthcare, consumer defensives. So again, the reason why I bring this up is because you cannot trade in September the same way you traded in June. Okay, in June, you could be more aggressive. You could trade tech. You could shoot for bigger wins. You could hold longer. Stocks were trending. Stocks were hot. Tech was hot. Okay, now you got utilities doing well. You got boring financials doing well. You got value doing well. Okay, and then those other stocks are not doing well. So if you put your head down and operate the exact same way at all times, you lose, because you make money and then you give it back, and then you make money and you give it back. Okay, you have to note what's going on and make changes. Okay, so right now, a different basket of stocks should be considered if you're trading to the long side. In some cases, you got to lower your expectations and only expect to hold for maybe a couple days rather than a couple weeks. You got to be content with smaller gains instead of shooting for big 20, 30, 40% gains. In baseball terms, you're just swinging for singles. You're not swinging for the fences. Okay, make the necessary changes or else you will lose. Okay, hope you got something out of this, and I will see you next time.